Have you ever wondered how a lender arrives at your actual house payment and what the house payment consists of? Well, if you're going to take your national real estate licensing exam, you'll need to know how to do this just to get through your exam and pass your test. But it's also great information to have if you're looking at purchasing a new house or you want to estimate what the house payment would be on a new home purchase. So what actually is in your house payment? Consists of four pieces: principal, interest, taxes, and insurance. In this video, I'm going to break down each one for you and tell you how the home payment is calculated. Welcome. Here's another video from Tom's Next Level Real Estate. I'm Tom, and I've been teaching real estate for over 25 years, and I'm here to help you pass your licensing exam and take the mystery out of house payment math. Your home payment is made up of four distinct pieces: principal, interest, taxes, and insurance. I'll show you how to calculate each portion. We'll talk about loan payment factors and how they can change with each interest rate, and then how your property taxes and homeowners insurance gets paid to your lender. The largest part of your home payment is going to be the payment for principal and interest. That's the PI in PITI. So your principal and interest payment amount is determined by using payment factors. The bank will issue their own payment factors for each interest rate and term. So a 15-year term at 6% interest will have a different payment factor than a 30-year term at 6% interest. When you're taking your exam, they'll give you the payment factor to use in the question, or they may give you a table of payment factors. So there'll be a list of payment factors on a table, and they will be for a 10-year, 15 or 30-year term, 5 or 6% interest, and then you'll use that table to determine the payment factor to use when answering your question. Now, the important thing to remember about payment factors is the payment factor is a number that will tell you how much the home payment is for every $1,000 you have borrowed. More on the next slide. Let's take a closer look at this payment factor. Notice that we're talking about a buyer who wants to borrow $100,000. When you're taking your exam, make sure it's not the purchase price of the house. They may tell you somebody wants to buy a $100,000 house and put 10% down. That means the loan amount won't be $100,000. The loan amount will be $90,000. So make sure you're calculating based on the loan amount. And in our example, a 30-year term with an interest rate of 6%, the payment factor would be $6.60 per $1,000 borrowed. Here's where you want to pay attention for the exam. This is $6.60 for every $1,000 that is borrowed. Well, how many thousands of dollars are being borrowed in a $100,000 loan? Clearly, $100,000. So that's how you want to make your calculation. And this payment factor can vary with the term and with the interest rate. So let's take a look. First of all, what would the monthly payment be for principal and interest on this loan? Okay, let's break this down a little further. The buyer is borrowing $100,000. The payment factor is based on how many thousands of dollars the buyer is borrowing. So how many thousands are there in $100,000? Well, there are 100 thousands. So you're going to take the 100 and multiply it by the $6.60 for every 1,000, and that'll give you your monthly payment. So $6.60 times 100 is going to be $660 for the monthly principal and interest payment. Remember, this is principal and interest only so far. Well, here's a further calculation you're likely to have to make on your real estate licensing exam. We said the total payment for principal and interest is $660 per month. Well, here's an interesting question. How much of that is principal and how much of that is interest? That's a calculation, again, you're likely to have to make, and let's walk through that calculation. In order to separate the principal and interest in the monthly P&I payment, we need to take a couple of steps. The first thing is, let's look at the total loan balance at the very beginning of the loan. It's how much? $100,000. And we know the interest rate is 6%. So what's the annual interest on a $100,000 loan at 6%? The annual interest is going to be $6,000. You multiply those two numbers and you get $6,000. But that's the annual interest. And we have to break that into a monthly segment, okay? So we're going to divide the annual interest by 12, and you will come up with $500 interest in that first monthly payment. So of the total payment, $500 is applied towards interest on the loan. Well, we said the whole payment was $660. We subtract the $500 from the first payment, that is the interest amount, and you come up with $160 balance that will be applied to pay down the principal of the loan. So that's how you're separating interest and principal in that first P&I payment. Here's an important concept to understand after that first monthly payment is made. Since $160 of that first monthly payment was applied to pay down the principal amount on the loan, which was $100,000, after that first month payment is made, the new principal balance is reduced by that $160. So the new principal balance is $99,840. And you would do this every month if you wanted to create a full 30-year amortization schedule to see how much of the monthly payment gets applied towards principal and how much towards interest. At the end of our 30-year term, the entire principal balance would be paid down to zero. Well, that covers the principal and interest portion of the PITI payment. Let's talk about property taxes. That's a simpler calculation. We can estimate the annual property taxes by using local comps you might find on the internet or in other realtor sites. But in our example, we'll use $3,600 as an annual property tax. But remember, we're talking monthly payment. So please don't forget in your exam to divide the annual property taxes into 12-month segments. So we have $3,600 annual property tax divided by 12 will give you $300 a month for property tax payments on our example. To come up with the homeowner's insurance portion of the PITI payment, we have to do a little estimating. In our example, our buyer wants to buy a $150,000 house. That's the total value of the house. They're putting $50,000 down and borrowing $100,000. But for the homeowner's insurance, we have to go back to the total purchase price, the total value of the home. If the value of the home is $150,000, we're going to estimate that homeowner's insurance will cost the buyer $4 for every $1,000 of home value. Now, just like we did with our payment factor calculation, we have to break down the value of the home into how many thousands of dollars are there in this home value. $150,000 home value equals 150 thousands. And our estimate of the homeowner's insurance at $4 per thousand is just then going to be multiplied by the 150, and we would come up with $600 annual insurance. Now don't forget on your exam, that's an annual number. We need to break it into a monthly number. So we take the $600 annual homeowner's insurance divided by 12, and you'll come up with the $50 per month for homeowner's insurance. Let's put these pieces back together now to come up with a total PITI home payment for this buyer. The principal and interest portion was $660 a month, $300 a month for property taxes, and $50 a month for homeowner's insurance. That leaves this buyer with a total home payment monthly of $1,010. That's the total PITI payment. I hope you found this video helpful and informative. You can check out my YouTube channel at Tom's Next Level Real Estate. I have national exam topic videos on all 10 topics that you'll be tested on. As always, stay focused and positive. Good luck on your exams. And I'd appreciate it if you would like, comment, and subscribe to my channel.